Welcome to Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth.
Hey everyone, it's James Santiago, and today you're watching your show, Learn Wealthy. Today we're diving into share buybacks. What are they, why companies do them, and how they affect you as an investor. Spoiler alert, it's more than just stock price movements. Stick around and we'll break it down. First, let's start with the basics. What exactly is a share buyback? In simple terms, it's when a company uses its own cash to purchase shares of its own stock from the open market. These shares are either canceled or held in the company's treasury, reducing the total number of shares outstanding. But why would a company buy its own stock? It's like them shopping at their own store? Kind of, but there's a strategic reason behind it. Companies initiate share buybacks for a few key reasons. Boosting earnings per share, EPS. When a company buybacks its shares, it reduces the number of shares in circulation. With fewer shares, the company's profits are spread across a smaller pool of shares, increasing EPS or earnings per share. Higher EPS can make the company look more profitable, returning value to shareholders. Share buybacks are a way for companies to return excess cash to shareholders without paying a dividend. Some investors prefer buybacks because they are more tax efficient than receiving cash by dividends, which are taxed as income. Signaling confidence. Buybacks can be a sign that company's management believes their stock is undervalued. It's like they're saying, hey, we think our stock is a good deal, so we're buying it back. Offsetting dilution. Sometimes companies issue new shares to employees as part of compensation packages. Buybacks can offset the dilutive effect of these new shares to keep the share count steady. Now let's get to the part you're most interested in: how share buybacks affect you as an investor. There are a few key ways. Stock price increase. Fewer shares on the market can lead to an increase in the stock price because of the basic principle of supply and demand. Less supply with the same demand can push prices higher. This benefits existing shareholders as their shares become more valuable. Higher earnings per share or EPS. As I mentioned earlier, buybacks can boost a company's EPS. This can make the company look more profitable and can lead to higher stock prices if investors are willing to pay more for higher earnings. Tax efficiency. Some investors prefer buybacks to dividends because they don't trigger immediate tax liabilities. When you receive a dividend, it's typically taxed as income. But with a buyback, you can choose when to sell your shares and pay capital gains tax, only when you realize a profit. Signal of management confidence. Buybacks are often interpreted as a positive signal. If the company is willing to use its cash reserve to buy its own stock, it could indicate that management believes in the company's future prospects. But here's the thing, it's not all sunshine and rainbows. Not all buybacks are great news. Sometimes buybacks can actually hurt shareholders if they're done for the wrong reasons. For example, if a company is using buybacks to artificially inflate its stock price instead of investing in growth or paying down debt, it's kind of like putting a band-aid on a much bigger problem. It might look good in the short term, but in the long run, it could leave the company cash poor. Also, some companies may overpay for their stock during buybacks. If management buys back shares at an inflated price, they're not really creating value for shareholders. In fact, they're wasting the company's cash. So should you love or hate buybacks? The answer, as always in finance, is it depends. If a company has a strong cash flow, minimal debt, and is investing in future growth, a share buyback can be a great way to return value to shareholders. But if it's just a tool to make the company look more profitable on paper, it could be a red flag. As investors, it's important to not just take buybacks at face value. Look at the bigger picture. Look at the intangibles, the company's overall strategy, its financial health and fundamentals, and whether or not management is using buybacks responsibly. As an investor, you should know that the stock market, the big casino, is not all fundamental. A huge part of it is based on narrative. As a matter of fact, I would argue that the majority of it is narrative instead of solid fundamentals. Otherwise, why would the stock market be twice the size of the US GDP according to the Buffett indicator? It's important to know the fundamentals, but it's also important to know the prevailing narrative about a company and the economy in a macro level. That's all for today's video. If you found this video helpful, be sure to hit that like button and subscribe to the channel. For more finance, investing, real estate, and macroeconomics, let's all learn wealthy together.